My name is Arthur Mrozowski, and I'll be moderating shortly the panel. We have 30 minutes today, so I'm not going to blab too much about myself. I'm originally based in San Francisco Bay Area today, originally off the boat from Poland, so I come to visit Poland at least once a year.
Arthur, you're really low volume, Arthur.
I'm moderating the panel today from.
Hey, Arthur, is there some way you can turn up your volume?
Silicon Valley Venture, you can look it up. We've done 2 exits, and have a lot of experience dealing with the fintech through my kids that are probably far more successful in the area. And I'm supported with my friend from Pebble Beach, Andre Herrera, which is also a fintech support in the sense of my dealing with the startups in the valley from the point of view of the banking compliance. But the panel is fantastic as usual. We have a group of the experienced panelists, and we met here for probably third or fourth time, but each time we always come up with the good set of information. So let me start with the Daniel McAvoy, I'm sorry, who is the one of the partner hosting company here, Polsinelli, Julia Valentine, Chief Operating Officer, and then CTO at AlphaMille. And then we have Sai, then we have Andre Herrera from Hypur. So let's start with the Daniel, and then Daniel, if you can tell us a little bit about what it is that you do, and then we'll go to Julia, and then Sai and Andre.
So hi, I'm Dan McAvoy. I'm a shareholder here in the New York City office of Polsinelli and the co-chair of our fintech and blockchain practice. I've done extensive work throughout the fintech space in a number of different areas, a lot in the capital side. So my experience is largely kind of as a securities lawyer and compliance lawyer. And from there, I've done a lot of work with broker-dealers, investment advisors, fund managers, fund formation, investments into fintech and into the blockchain space, and also as kind of have done a lot of asset fractionalization. So was the first person to do Reg A plus offerings of real assets. So
okay, Julia.
Wonderful. Hi, Arthur. Hi, Andre. It's great to see you there on Zoom. I've been in technology for 20 plus years, started out in tech at JP Morgan, and went on to D. Shaw, and then ran tech and ops at a very large family office, top 10 in the world, and then was CTO, COO of a pension fund of Wisconsin, $110 billion under management. So I've looked at tech from sell side and buy side perspective, and currently I'm a consultant with AlphaMille and managing partner with AlphaMille, and an advisor to multiple fintech and other startups.
Hey, Sai.
Great to be here.
Hello all. I think I'm probably the youngest in the room here. So,
Most.
Right. So yeah, I'm Sai. I graduated from Columbia University last year, pursued economics and statistics. And while at the university, I was working with Ministry of Commerce, Government of India, in there basically attracting foreign direct investments to Indian infrastructure projects, real estate, solar power plants. So my work was to how to best project sort of these projects to foreign investors. So it's more likely they would come to India and invest in those government projects, right? So it's basically dealing with market conditions, data models, crunching those market variables, sort of market data into those models, and then showing that models in real time to foreign investors. So it was a lot of manual work. And then, but yeah, soon then worked with multiple real estate firms like Lennar International and then Japan Bangkok International Corporation in there basically as a data associate, crunching numbers into their models and updating those models in real time, and then work with Oxford Analytica in risk mitigation, sort of in their insurance sort of advisory. Then pursued research at Columbia, basically as an undergrad, did my research also inside in terms of how should institutional investors invest in infrastructure projects. Why does due diligence take so long, and what are the problems, and what's the information should they look at before investing in a project? So basically in economics of information, that was my research. But yeah, transitioned all of that experience into a startup now, which is called Wintra, Wise Investment Prediction Assist. So that's sort of my background.
Nice.
Thank you. Andre?
Yes, great. Thank you, Arthur. Well, my name is Andre Herrera, and I am the Chief Compliance Officer for Hypur. And we are a regulatory technology company in fintech. We also provide payment solutions primarily to banks and credit unions that are involved in higher risk industries. My background is I've been in financial services over 30 years at this point, and 18 of those I worked in commercial banking, where I managed and ran all of our payment solutions and card-based solutions. And so I was an early adopter into stored value cards. I issued debit cards, credit cards, ACH aggregation. I supported a lot of those early fintechs. And so for about close to 2 decades, I was a sponsor bank for fintechs before actually working for a fintech. And so payments, banking, and compliance is my wheelhouse. And what I love the most about the space is I love new innovation. And so I love bringing out new products and dealing with all the compliance aspects to actually enable these new fintechs and products to come to market in a safe and compliant manner.
Well, let's get the ball moving, as I said. The trends nowadays with the fintech, as I see it, at least through the companies that I'm involved in, is that a lot of money's got blown up by a lot of startups. There's another BNPL and DeFi crowdfunding and so on. But I think what seemed to be like still out there, sticking into the wall, right, is the all of the aspects of the ledgers that are the and peer-to-peer payments. I mean, that seemed to be still getting some traction, although there's quite a bit of regulatory issues with it. So I wanted to ask Daniel, since he's like the most qualified expert from the legal point of view, what are the big challenges in the fintech nowadays in terms of the regulations and in incorporating those new ideas?
Well, I think there are a few pieces of it. I mean, number one, and I suspect, I know that we have a panel on blockchain and DeFi and stuff like that coming right after this, but that really has piqued the regulators' interest in a lot of different ways. And so what we're seeing is particularly the SEC. Gary Gensler, who's the chair of the SEC, just today gave another speech saying that he thinks that everything's a security and that everything needs to be very heavily regulated, and that we all need to go ahead and make sure that we're registered as exchanges and everything like that. But part of it is that, because you have this additional attention that's being thrown at the sort of crypto and DeFi world, they're also doing a lot of things that are really capturing much broader swaths within this. So, for example, there is a proposed rule that would change what the definition of stock exchange is. And that actually has the potential to capture a lot of fintech companies that really consider themselves to be more data providers or service providers that are just providing a technological front end. So things that might just be a front end now may actually wind up being very heavily regulated in the not too distant future. We're also seeing that in the anti-money laundering space, where there had not really been a whole lot of attention paid, I think, in fintech, unless you were a heavily regulated entity. We're now seeing that fintechs are being proactive about doing anti-money laundering, about doing KYC, about things like that, even though there isn't necessarily a specific legal requirement, just because of fear, relating to OCC sanctions, various other things along those lines. And then I think that there is, in addition, sort of this potential for additional regulation where it comes to interactions with banks. One of the commissioners of the OCC said yesterday, I think, that that this is something that they're looking at and potentially trying to figure out ways that the fintechs who are sort of the front end for certain that are utilizing regulated banks and how those interact and how it is that that the fintechs themselves may actually need to be regulated, because right now it still is a lot of borrow a license type of a situation.
Daniel, I've got that quote from the OCC yesterday, if you'd like me to read. I found it pretty interesting. And so it stated that the de-integration of banking services that is now taking place has its roots in technology, data, operations. It's affecting all banks, not just the large money center banks. My strong sense is that this process left to its own devices is like to accelerate and expand until there's a severe problem or even a crisis. To me, that's a shot across the bow. And so if that wasn't, there was no hiding that kind of comment. And so if you're a fintech, you need to be looking more closely at compliance, based on that statement yesterday from the OCC.
Yeah, I've read that article as well. But I like switching gears a little bit towards Julia and her kind of interests of the subject. I wanted to give everybody kind of a chance to talk about different things, and I know that Julia, you're working with the family offices for the longest time, and like, what are your biggest challenges now with the family offices and then PE funds in the terms of the fintech technology or technology in general?
There are so many. I'll just focus on one for the sake of time.
Sure.
I remember when I was starting out at JP Morgan, I worked on a project. It was putting equity derivatives into the value at risk Monte Carlo simulation. So in year 2000, on the public side, in public markets, we knew exactly how the entire portfolio would perform under various scenarios. Now, if you fast forward to today, a lot of family offices that have private investments and a lot of venture and PE funds, if they know their hurricane is coming, they won't be able to tell you which of their portfolio companies are going to be affected. I mean, they should have that data, but most of them just don't. They either don't have the capacity to collect it or their systems don't store it efficiently. So they really don't know. And it is surprising and shocking, but that's where we are today for various reasons. So one of the big challenges in fintechs, for fintechs right now, is literally that last mile of bridging what the firms need on the buy side and what they can get out of the box. So it's literally, that is the question. How do you do that? And there are lots of solutions that we can get into if time permits.
We've got
That's
about
good.
15 minutes left in the panel, so
Yeah.
if you're going to get into it, go fast.
Okay,
Yeah.
sounds good, Marty. Let me actually get into something more kind of interesting, at least from my point of view, because Sai is a build this company Winpra, right? Which is kind of a fintech orientated to a degree, because what he, at least my understanding is, he allows the financial institutions to make a smart decisions based on the data that nobody else can actually digest and interpret it in a meaningful way into something that will potentially make them better decisions. So Sai, tell us about, like, what is it that you do at the Winpra, right?
Mhm.
Or
Right,
okay.
Winpra.
I mean,
So
the W's and V's are kind of interchangeable in European languages sometimes, like if I stay too long in Europe, then it's becoming different pronunciations. So, but anyways.
So yeah, since morning, I think we have been hearing a lot about data and uncertainty in markets and real estate and all of that. So yeah, we are working in sort of intersection of all these three.
Hi,
So
this is
we-
Brian.
So we are building a sort of a product for institutional asset managers and private equity who hold sort of huge amounts of real estate properties, multifamily, hotel units, and all of that. So, and each property has an underlying Excel model. Whole real estate works in Excel, right? And most of those models are nothing but estimations. Your IRR estimations, net profit estimations, debt service coverage ratio, all of those estimations. But estimations still remain as estimations. They are not overwritten by actuals. And what those actuals are, your market conditions, your real-time asset performance. And these models are nothing but data input feed of these market conditions like your occupancy rate, your interest rates, LIBOR rates, SOFR rates, and all of those interest rates, which are changing on a daily basis. And then you have asset performance metrics like your expenses, revenues, and how much sort of how much am I paying for security service? So all of these different line items that asset generates data on a daily basis, and mostly it's accounted for a month. Every month you get data generated by the asset. So what we do is basically, before that, the problem is these models do not get updated in real time. Estimations remain as estimations, and mostly real estate sort of folks, asset managers, for the data, the decisions that they take, basically they react to the market changes. And by the time they react, it's too late, whether it's interest rate or the internal asset metrics. So what we do is we integrate with internal asset management softwares to track the asset data. We integrate with market analytics firms, so to track interest rates and all of those, and ingest all of that data into sort of customers' proprietary models, so that whenever market conditions or asset performance metrics change or update as numbers, your underlying models are updated. So now you're not reacting to the market changes, but you're a proactive investor or a proactive asset manager, managing your assets in real time. All your models are up to date, and you know where markets are moving, so you can accordingly calibrate your models and assets accordingly, and then take decisions. So it's an end-to-end asset management platform for institutional asset managers.
So currently, are you actually well funded, or is that something that you're seeking? You're raising money for your company, or what's the stage of it?
Right. So currently we are piloting with 50 assets from Florida to New York, mostly multifamily assets. And we have sort of instantiated their models and connecting the data pipelines to different internal and external softwares. And these are $2 billion asset managers. But yes, in short, we are raising funds. We have around 5,000 assets in waitlist owned by huge asset managers in New York. We are raising seed of $2.5 million, and we have a committed capital of $1 million already. So by the end of this year, we are on track to sort of handle minimum of 10,000 real estate assets, mostly in the East Coast is what we are focusing on.
Yep. Okay, sounds good. I wanted to go back to Daniel, and his legal expertise. That actually is kind of interesting. Is that, how do you perform the due diligence on some of those fintechs that have all those new digital assets, issuing the cryptocurrencies and so on? How do you deal with this? And then
there's kind of a fundamental difference between investing in sort of what I would call like a venture digital asset, right? You have something that it's going to be a token, it's associated with the project, they're trying to build something. Eventually, someday you might be able to go ahead and sell it. Maybe you can, maybe you can't. But I think that sometimes there's kind of a fundamental misunderstanding, because people who come into it with sort of a venture investing mind frame, like what you care about if you're buying, getting a safe in his company, it's like, all right, well, it's his company. You're going to build out the company, you build out the product, the company is going to own the product, and you get, a slice of whatever profits, or if there's a sale or exit event, whatever else like that. When you're dealing with like sort of digital venture, you don't really care that much about the company. What you really care about is the project, the people, making sure that things are actually tied to it. Because what we frequently see, in fact, is because in the US, it's a bad regulatory environment to be able to even sell these things. So what people do is they go ahead, they set up a Cayman Foundation, that has no owners, they put a BVI entity underneath that. That BVI entity goes ahead and sells the tokens. So what the company that's issuing the tokens is just like something that's sitting out there. All it does is manage the treasury, and it's quite possible that people even try to have it run by what's called the Decentralized Autonomous Organization, or DAO. And we saw not that long ago a venture investor that the DAO, there's a bunch of people just voted and they said, hey, we're not going to give, they bought a SAFT, which is like a safe for tokens. And the DAO said, we're not giving it to you. And that was it. There wasn't anything they could do about it. So, I mean, so what you're really trying to protect against is like what we call a rug pull. You want to make sure that like what it is that you're buying is actually going to be tied to that project, that the project is going to move forward, and that over time you're able to go ahead and sort of derive that value, but it doesn't necessarily apply to that specific company.
Andre, I have a question for you. A lot of fintechs, they raised a tremendous amount of monies, right? Recently, they came up with the different ideas and form of payments and so on, but they had to rely on the banks, right? And the banks were adopting them in some form. They build the relationship, they rip them off, kick them out, and so those new startups literally gave them hundreds of thousands or millions of dollars, right, in the fees for having them being an institutions that allow them to be in existence, right? But there was no like there was no rules and regulations in the sense of them being protected, meaning the fintechs. I mean, how what are the challenges of getting that marriage between banks and the new upcoming fintechs, and how do you protect yourself from being screwed, literally? Because like the banks can, without banks, a lot of those fintechs cannot exist on their own, right? And then so bank is in charge, and they can suck up all the raised money, and then they kick them out, and fintechs go whatever goes away, right? So can you like tell me, how do I protect myself from or
Yeah, absolutely. So let's go into it, just a little bit of background first. And so you have the challenges that the banks have with their regulators, and then a lot of those challenges get passed on to the fintech. And so, if you're a bank that's servicing, fintechs, you're dealing with, regulatory risk, you have transactional risk, you have reputational risk, you're subject to civil money penalties, you're subject to C&Ds. And so you have all of these banking regulations that exist. We've already mentioned like CIP, I still call it KYC, but you have, BSA, AML, you have transaction monitoring. So you have all of these things that the bank has to do to stay compliant, with their regulators. And so a lot of those things get passed down to the fintech company, whether they know it or not. And so a fintech really is a compliance company that is in the financial services, business, or the crypto business. And so, some of the fintechs think that, they're not subject to all the banking rules because they're not a bank, right? But, we've already talked about how a fintech has to have a sponsor institution, and that sponsor institution will start pushing down those regulatory requirements, to the fintech. So, you almost have to think that even though I'm a fintech, I'm pretty much subject to all of those banking rules, because if I don't comply by the banking rule, my bank's going to get in trouble and they're going to drop my account. And so they're going to cut me loose. And in some cases, these fintechs are even subject to more regulations, than a bank. If they are utilizing the bank's charter for certain products and services, well, that will ease some of the regulatory burden on them. But if they're not, then if they're in money transmission services, now you're looking at the registration as a money transmitter at the state level, which all states have money transmission laws that regulate that. And so you actually have to think about the compliance if you're a fintech, and compliance should be your first thought, almost when you're building the product out. So I talk to a lot of people that have this, they have great ideas, great fintechs. I got an idea for this product or this payment solution or this type of token. And they think about the product without thinking about what aspects of compliance is required to support that product. All right, so if I'm a fintech, and let's go back to your original question, what do I do to help keep my sponsor bank relationship and keep those things in place that I must have? And the bottom line is put compliance at the top of your list. And so you need to think like a bank thinks. You need to have all of the due diligence within your organization that the bank is going to want. If you're dealing with card data and if you're storing PAN information, then you got to look at PCI. I always say get a SOC. And so you get that statement of controls. And so you have those types of third-party audits and reports that will keep your bank sponsor warm and fuzzy, and it'll help ensure that you're in compliance with those types of regulations. So think like a bank, do everything that your bank sponsor expects of you, and be proactive on compliance.
Guys, got about 5 minutes on this panel.
Okay, sounds good. I just wanted to ask Daniel about his experience in family offices, investing in a fintech, in general, and then also wanted to let you know that the Queen passed away, unfortunately.
Oh, geez.
Yeah.
Sorry.
A little bit old.
Sorry.
96.
Yeah. But
Well, on that note, yeah, I mean, look, I mean, one thing that has really become a major aspect of fintech over the last 4 or 5 years has just been democratization. I mean, that's what everyone's just trying to get access to deals, more access, and that can be through family office networks, that can be through online fintech platforms, it can be through a lot of different types of things. One little trap though that I have seen on more than one occasion is where a single family office that's relying on the single family office exemption will go ahead and try and use like sort of an angel network and wind up actually essentially providing advice to a fund. So rather than having other investors coming in alongside them, they're actually kind of managing the vehicle and have the potential to sort of blow the single family office exemption. So it's something to think about if, like, say for example, Angel List or something like that, if you want to go ahead and lead through that, to just consider and make sure that you don't do something that might cause you to lose the exemption.
So my quick question is, and it's happened to me all the time, people come to me and say, I got XYZ number of co-investors, but I need a lead investor. And 99% of the time, family offices are never the lead investor, right?
Yeah.
So you're saying that being a lead investor is problematic.
It could be depending on how you put it together. I mean, there certainly are structures where you can avoid that, where there's other people who are just kind of alongside you. But I have seen it where somebody, people say, oh, well, we want to be able to collect a fee off of stuff, or we want to be able to have expenses paid, even like anything like that. You start to really veer into that territory, and having a vehicle even that you manage, even if there isn't a fee associated with it, like does have the potential to
a vehicle, like a holding company.
Well, yeah, like what we call a special purpose vehicle.
Okay,
like so,
SPV,
yeah,
okay.
yeah,
So
yeah,
you're
exactly.
saying a family office SPV may have to be breaching some rules.
Yeah, it's just you just have to be careful in putting that together and structuring the SPV and making sure that's done in a way that it's clear that what you're doing is either not providing investment advice with respect to securities or not providing investment advice. So.
Right. Yeah, I mean, the most common structure I see with family offices is there may be several family offices or high net worths involved in a direct investment.
Yeah.
But almost all the time there'll be a VC nominally who will be the lead investor.
Yeah.
And they create the term sheet and everything else.
Yeah.
And that's, I think, it seems like you can't go wrong with that.
Yeah, no, and that's something that people do, and I know some family offices that have an ERA underneath it, right, and have a VC down below. Once again, you just got to be careful about the structuring.
Got it. Okay.
Yeah, because I think that essentially in terms of the fintech, you don't necessarily want to even have the family office involved until you have some kind of a path through like a smarter money, right? Because just to get the money is a one good thing, but in order for you to be successful, you have to pretty much get a VC money or somebody that is heavily involved in understanding how to pave through the industry. So how much money do we have left? Marty?
One more question. One more question.
Yes. Okay, great, fantastic. I would like to go back to actually general panel in the terms of the current situation, and then see what do you guys think, just to summarize really quickly, what do you think the biggest opportunities are with all of the things that are going on in the fintech in general? Where do you see, where do you smell the money? Julia?
A number of areas. The first one is I think that companies that solve the data issue, and especially they sit in the middle, they sit between the systems and the data providers, and they do some kind of a conversion of it to make the data easily digestible. So either they turn it into KPIs, in plus data, or some value added there to help companies take that next leap forward towards using data for investment decisions, using it for risk management, portfolio monitoring, etc. So that to me is where you should look. Those are going to be successful.
Daniel, what do you
I think support of businesses that help support the blockchain DeFi space, I think to some extent. We're starting to see a little bit of convergence between traditional fintech, like MakerDAO, for example, just took down along with a traditional bank, various other things along those lines. So I think that's one area, and this isn't exactly fintech, but just from a general perspective, I think neural net is another area that it seems like we're at the top of the first inning when it comes to that, and part of sort of the build out of energy and things like that, all the Bitcoin mining, and we have the merge going on. People are going to use that power for other purposes. And so I think that that's going to be an area that a lot of people end up pivoting into.
Sai?
So I completely agree with what Julia said. What I think is there's a lot of data silos in every industry, especially in real estate. And when you have so many properties, each asset generating a lot of data, and there is market data, and each asset in different county, different region, and that county follows a different market metrics altogether. But long story short, I think business sort of aggregating all that data and ingesting into sort of their own sort of models, reducing the time of extracting, ingesting data, and analyzing the output that comes out of the model. If this sort of process, the time is reduced, if businesses work in that, then I think most time can be spent on data-driven decision making more smarter decisions. So businesses focusing on that, I think, would be a great strategic investment.
Andre?
And I'm going to join the data train as well, but from a different perspective, from the compliance perspective. Regulatory issues are only going to be increasing for the fintechs, and being able to get transactional information, that transactional data that can be analyzed, is going to assist all of those sponsor banks in making sure all of the BSA AML requirements are met.